Like and subscribe and click the bell icon to get new video updates.
Borrowers should brace for a 15% fall in home prices as interest rates rise, warns RBA. The Reserve Bank is warning of serious risks for those who are heavily indebted with limited savings buffers, while painting a generally upbeat picture of the resilience of Australian households as interest rates rise. The bank's twice-yearly Financial Stability Review, FSR, reported that, on the whole, Australian mortgage borrowers are in a much better position to deal with rising interest rates than they were before the pandemic. Most indebted households have benefited from strong growth in housing prices over the past year and, coupled with higher mortgage repayments in excess of scheduled requirements, the vast majority have accumulated substantial additional equity in their homes, the report noted. The RBA estimated that only around 5% of loans now have an outstanding loan-to-value ratio, LVR, greater than 75%, compared to almost a quarter at the beginning of 2020. This means that for 95% of borrowers, it would take more than a 25% drop in home prices to send them into negative equity, the dangerous position where the borrower owes more to the bank than their home is worth. The share of loans in negative equity is also estimated to be exceptionally low, at less than 0.25%, down from 2.25% in January 2020, the review added. House price falls forecast. The improvement in both of these metrics has been mainly driven by the exceptional surge in housing values during the pandemic, with property prices surging by almost a quarter over the past year in the steepest growth seen since the late 1980s. However, the RBA also warned that much of that gain is likely to be unwound over the next couple of years as interest rates rise. Estimates using a model of the housing market that takes into account historical relationships between interest rates and both demand and supply factors suggest that a 200 basis point increase in interest rates from current levels would lower real housing prices by around 15% over a 2-year period, the FSR noted. It is important that lenders and borrowers consider the potential for falls in housing prices, particularly for loans at high LVRs. Recent buyers most at risk from rising rates. Aside from sinking housing prices, rising interest rates will obviously also increase repayments for existing borrowers. Read more. Analysis by the Reserve Bank revealed that most borrowers should be able to cope with these higher repayments relatively comfortably. If interest rates were to rise by 2 percentage points, which is around the middle of current economist forecasts, the RBA's analysis found 40% of borrowers are already making average monthly repayments that would cover the increase in minimum repayments. Another 20% would see their repayments rise no more than 20% from what they are currently paying. However, 1 in 5 borrowers would see their minimum repayments increase by 40% or more. These borrowers also tended to have lower accumulated savings and loan repayment buffers than the average mortgage customer. While the average borrower has a buffer of around 45 months, at current interest rates, the median, or typical, borrower is around 21 months ahead, up from 10 months at the start of the pandemic. However, of the quarter of borrowers whose repayments would rise by 30% or more, only around half have accumulated excess payment buffers equivalent to at least a year's worth of their current repayments. So the households facing the biggest increase in repayments, dominated by more recent home buyers, also on average have the smallest financial buffers saved up to cope with those higher repayments. With 2 percentage points of rate increases, the proportion of borrowers facing a debt servicing ratio greater than 30% would double from around 10% to just under 20%. This is considered a level of repayment that puts borrowers in, or at higher risk of, mortgage stress. Falling real wages a risk to the financial system. The Reserve Bank also warned of the potential risk of a double whammy for households facing higher interest rates if wages growth did not also pick up to match. If rising inflation was to erode real household incomes, some borrowers may have to draw down their accumulated excess payment buffers much more quickly and/or cut back on other spending, it noted. There are some risks around borrowers' capacity to pay if rising inflation is not accompanied by faster household income growth and rising business profitability. That led the Reserve Bank to conclude that medium-term systemic risks remain elevated. It is important that lending standards do not slip and that borrowing and lending decisions are resilient to higher interest rates and the potential for falls in housing prices and/or real incomes, it cautioned. High debt to income.